Want to talk today about three things in today's podcast. One is that there is good news and bad news on the inflation front and interest rates. The good news is that inflation in the UK has fallen to 1.7%, so it's below the 2% target, which they've met months ago. And it seems to be falling in the US and in Europe as well. So that could mean that we will see interest rate cuts, the Bank of England interest rate cuts this month or next month when they next meet. So that's the good news. But the bad news is that lenders, bizarrely, have started to increase interest rates on their fixed rates. High street lenders like Santander have put up their rates. I'm going to show you a chart in a second. The other thing I want to talk about is the Renters' Rights Bill, which is working its way through Parliament. I'll give you an update on that. And finally, Rachel Reeves and the budget, which is coming up in 30th of October. There are serious tax rises planned or slightly sort of leaked so that they can gauge what the public opinion is, but we are expecting quite serious rises. So let me show you the first chart now on the interest rate situation. Okay, so there we have it. The surprise fall in inflation paves the way for interest rate cuts, according to the BBC. And we see now that inflation fell unexpectedly, apparently, to 1.7%. Well, of course it would. If the economy is almost crashing, you would expect less activity, less spending. People haven't got so much money in their pocket. Of course, interest rates will fall. That's the sledgehammer they use to crack a nut. But it's the lowest rate for 3.5 years. It's now below the Bank of England's target. Now they've been at or about this target for months now. So let's hope the Bank of England come and wake up and see what's going on in the real world. That people are struggling here, and you know they need a bit of a break here. Now, incidentally, I've been looking at interest rates on a refinance of an existing fixed rate, which came to an end after 5 years. Luckily, I was in a 5-year, and wow, you know, payments are kind of double. There's not very good rates from the existing lender. You go to another lender, they ask like a million questions, some stupid questions they ask. You know, where does this money come from? Well, it's in my bank. You know, where did that come from? I mean, it's like, it's not in a suitcase. I'm not turning up with a suitcase with deposit monies and that sort of thing. It's really bizarre, the sort of questions they ask. Some brokers have said to me it could be because it's the last quarter of the year and they've reached their lending target, so they start turning off the taps. Lenders do this. They, you know, at the start of the year they turn on the taps and they just give out money and let it flow out. And when they've reached their targets, they often, you know, rein in the horses a bit and say, hold on a bit, hold on, let's slow down a bit. So there we have it. And you know, this should mean that we'll see interest rate cuts as we have in other countries as well. UK interest rates are at 5%. So they're at 5%, okay? They only made their first cut in August after a couple of years. And yet they were around about 5% when we had 11%, 10 and 11% inflation. And they said, oh, it's got to come down to 2% target. And it's come all the way down to 2%. And they're still at 5%. So come on, Bank of England, you've got to do something here. So they are expected to be cut in November, which I believe is the next meeting. But let's see. I just hope so. But what I don't understand is that lenders have started to increase their rates, and these are lenders like, I don't know, Santander. And I can tell you something that a few lenders now have definitely hiked up their fixed rates by around about 0.3%. So instead of giving better deals, they're actually giving worse deals. And some of the deals these lenders are offering have up to a £13,000 fee. So they say, yes, we'll give you a 4% interest rate, but with a £13,000 fee. Now that is not 4%, is it? It's more like 6 or 7%. Now, I want to show you the Renters' Rights Bill quickly here. This is where it is now. It's been debated in Parliament, had its second reading. So it's winging its way through. They're really off the mark with this. They're really not hanging about with this. This is one of the things they really want to get through. And you can see that the bill passage, it's now at committee stage, so that they're going through it now. Then it will be a reporting stage, third reading in the House of Commons. This is the Parliament you see on TV. And then it goes over to the House of Lords, which is the second chamber that Labour would like to abolish. They're getting rid of a load of hereditary peers. These are people who've inherited their peerage, their lordship, if you like, and sit in the Lords. ideologically and politically, they just want to get rid of those people because it doesn't suit their socialist ideology. But when it goes to the House of Lords, it will go for a similar sort of thing. So that could take 6-9 months. We don't know. Some bills drag on and on for years, but I think they want to get this through fairly quickly. So they're going to rush it through. Other things they're doing is bringing in euthanasia and as I said, getting rid of the House of Lords. Now, of course, we've got a budget coming up in October, 30th of October, I believe. And it says here, I mean, these are some of the milder predictions. Rachel Reeves considers raising capital gains tax to 39%. Now, we've already seen with capital gains under the Tories, they reduced the threshold at which you start paying capital gains from 12,000 to 6,000, and then again to 3,000, and that's what it is now. So I mean, the argument is that the rates for capital gains are lower than income tax. Well, why wouldn't they be? People have put their necks on the line to invest, whether it's in property or whether it's in stocks and shares where they're saving for their retirement, or whether it's for in a business. They put their necks on the line. They've worked very hard. Why should they be clobbered with capital gains tax when they sell that business? They've already paid business taxes throughout. So that's it could go as high as 39%. Some people have said 50%. I don't think it will go that high. They want to kind of bring it in line with the higher rates of tax. And it's currently paid by 350,000 people, levied on the sale of assets, including second homes, not currently on your main residence. God help us if they bring that one in. But these I think what they're doing is floating these ideas out there and to see where it goes, and then like test the water and then adapt accordingly. But inheritance tax is another one that I think will be hit. They're certainly going to do something there. As it says here, under the current system, profits from the sale of second homes at up to 24% of shares in the business, up to 20% are taxed at a much lower rate than wages are taxed. This is income tax at up to 45%. Okay, so inheritance tax is another area. Again, I think it's quite an unfair tax that people who built up wealth during their lifetime should be suddenly hit with this exit tax, if you like, and clobbered when it passes down. But of course, ideologically and from a Labour point of view, they love this. I believe that a socialist view is that wealth should be in the hands of the state, not in the hands of the people. Now they're not going to go that far, but they're just moving slowly, and I think that these things will come. Now they're talking about a 40 billion black hole. There was only a 20 billion black hole recently. Now it's a 40 billion black hole. So they're really pushing these tax rises. They promised that they were not going to increase taxes on people, but now they're saying employers will pay more in national insurance. That's an additional tax that employers pay, by the way. Employers don't only collect the tax for the government, for the HMRC, they also pay a tax on employing people. Now, if they put this up, how is that going to encourage employers to employ people, increase the size of their staff? Or is it going to encourage them to move more jobs abroad, as has been happening over the last few years? And the answer is, of course, it's going to encourage them to either move abroad and pay less corporation tax, which is higher than in many European countries at the moment, including Ireland and Portugal, and certainly lower than in many non-EU countries, higher than in many non-EU countries. So that's crazy. So businesses are leaving, millionaires are leaving, up to 2,000 millionaires have already left. And I think a lot more wealth will flow out of the country and less wealth will flow into the country. So anyway, Labour's plan to levy national insurance on employers' pension contributions. This means they'll be paying that as well. And the IFS, which is a left-leaning think tank, said this could raise £17 billion in a year. And then what they're going to do with that money? Give pay rises to public sector workers? I don't know. There's an old saying from, I think Margaret Thatcher said it, is that the problem with socialism is that they eventually run out of other people's money to spend. And I can see this happening again. There are other talks of wealth taxes and even an exit tax for people selling assets and leaving the country, as they have in Australia and Canada. And that could be a serious problem, because we haven't had these sort of exchange controls since I think when the Conservatives come to power under Maggie Thatcher in 1979, she abolished exchange controls. And that gave a massive boost to the economy because investors from overseas realized that they could put money into the country and take money out of the country. Of course, pay the taxes there, but not have these exchange controls or exit taxes. So if you're thinking about leaving the UK, as many people are, you could have an exit tax. But what can you do about it? The average person can't do anything about it at all. Most of the wealth and in the sort of middle classes are tied up in the hands of in property. So I don't think there's much you can do about it. You can't sell a property before the 30th of October unless you just give a forced sale value of it. But solicitor told me many people are trying to sell portfolios of property. So I don't think there's a lot we can do. Most of us are stuck. Of course, if your money is in liquid forms or it's in cryptocurrency and you haven't got a physical business here, then of course you can leave and go off to Dubai. But most people have got their businesses are here. It's not that easy to just quickly up sticks and go. They've got kids at school, they've got things here, they've got family, they've got ties here. It's not that easy. And the grass is always green on the other side, as they say, although there are some interesting places where people might want to go. But I'm not pushing leaving the UK, but I'm just saying it might be more difficult for the average person to just up roots, up sticks and go. And that's what I'm saying. So we'll have to see what happens in the budget, and I'll be reporting on that, of course, when we know the full details of it. Nobody knows exactly what's going to happen, but I'm expecting tax rises. Some have even suggested that landlords could be paying national insurance contributions on the rental income they receive. We'll have to see what happens with that as well. But they're certainly hitting the wealth makers, which is very unfortunate. On the other hand, they seem to be in favor of big business. They had a summit this week of massive multi-billion dollar businesses hoping to invest in the UK. There was a bit of scandal over the owners of P&O, but that seems to have been sorted out now. One of the pharmaceutical companies that will invest in the UK are the makers of the anti-weight, the weight loss drug Ozempic, which is the government is planning to prescribe to all people who are obese in the UK, as they say that, let's face it, fat people are more likely to be sick, have more time off work, and are less productive. So they want to give them this drug from this pharmaceutical company that was at this event they had this week, this summit, and then this pharmaceutical company will invest in the UK. What can I say? What can I say? So big pharma, again, big business, fine, but small businesses, Labour, when they're in opposition, said that they were going to tax the companies that didn't pay much tax here, like the Amazons and the Starbucks and Facebooks and all these sorts of companies. But we haven't heard much about that since they've come to power. So at the moment, I think the middle classes are going to be hit with tax. The pensioners have already been hit with the ending of the winter fuel allowance. And I think we're going to see a lot of small stealth taxes coming in that will make most people in the UK poorer. So let's watch out for this and see what happens. But I'm not sure there's any place to hide. We're seeing a lot of this around the world. Bear in mind that the world debt is apparently at $100 trillion now. We've got America at approaching $40 trillion of debt. Their interest payments are more than their defense budget. Here we're at nearly 4 trillion, not billion, trillion in debt. And that's going to take years to pay off. How they will deal with it, I don't know. A lot of people are suggesting maybe there'll be some change, digital currencies, that sort of thing coming in. We'll have to see what happens there. So in the meantime, have a great week ahead, and I will speak to you again soon. Do give me the thumbs up, the subscribes, the likes. I'm trying to build up my subscribers organically, so do check that out. And if you want to hear more from me, I do run a webinar on most Wednesdays, usually every other Wednesday evenings at 7 p.m. UK time, where I give you 3 steps to financial freedom. Thanks very much, and bye for now.